Prospector News is media for educational purposes only and should not be construed as advice. We are not a certified financial analyst, licensed broker, or fund dealer, exempt market dealer, or hold a license to provide financial advice. We provide no legal opinion regarding accounting, tax, or law issues. Nothing in this podcast should be construed as investment advice or the solicitation to buy or sell stocks or commodities. All opinions expressed are those of the participants and should not be relied upon when making investment decisions. Those decisions should be made with the advice of a personal financial advisor. If you have enjoyed our podcast, please hit the like and share buttons and be sure to hit subscribe. This is the Prospector News Podcast, and joining today is Jeff Christian from the CPN Group. He's the managing partner. Hi, Jeff. Welcome aboard.
Hi, Michael. It's good to be on board.
Jeff and I had a very interesting conversation at the recent Metals Investor Forum in Vancouver, and it made me realize that I had some false ideas about the paper precious metals markets. And Jeff certainly steered me in the right direction. I wanted to bring him on so that we could talk about the difference between the physical markets and the paper markets and why one should look at one versus the other, depending on what it is that they're trying to accomplish. So Jeff, what is the paper markets?
Well, there are various paper markets, and you have futures, you have forwards, which are like futures, but they're over-the-counter principal contracts. You have a variety of options. There are exchange-traded funds and exchange-traded products. So there are like silver indexed notes and such. And then there's a variety of instruments that individual banks and brokerage houses will do. For example, gold or silver indexed notes and managed accounts that will give you the price exposure or exposure to changes in the prices of gold or silver or other commodities, but not necessarily, they're not designed to give you physical metal, and they're not really designed or optimized to use to take delivery of physical metal. So there's a very big distinction between people who want physical metal and people who want exposure to changing prices of commodities.
Okay, so if I'm an investor that wants to have physical metal, I should be buying physical metal as opposed to paper product. I guess the average retail investor is probably getting paper exposure through ETFs. Would that be correct?
Well, I think there's a wide range of things. For half a century, my advice to people has been, if you want to buy gold, buy gold. There are other gold investment products like ETFs that are useful for investors. And, quite frankly, my portfolio, I don't use ETFs, but, I have physical metal, but I also have various paper products too, because I'm looking to have both to own physical metal, either in my own possession or in proximity to my own possession. But then I also have paper assets to take advantage of price changes, because that physical metal is a long-term holding. And the paper products that I use, futures, and I prefer options myself, those will give you exposure to the price changes, even as you continue to hold that long-term long position.
I see. Now, with the paper metal, we're essentially getting into fractional banking at that point, where the ETFs don't necessarily have to own ounce for ounce physical metal versus the amount of metal that's within their ETF. Now, is that correct?
No, it's not correct for most of the physical ETFs. I mean, most physical ETFs, and the big ones are GLD in gold and SIL in silver. Those are physical metals, and they're not fractional. They're ounce for ounce. So if you want to own gold or silver through GLD or SIL, or dozens of other ETFs around the world that own physical metal, they have 100% of the gold and silver that they say they have in their accounts, usually on an unallocated, rather on an allocated basis, so that that metal is there. It's not further hypothecated, and it's there. There are many ETFs and ETPs, exchange traded products, that will have a leveraged exposure. So they might be a long gold 2 times or 3 times, or short gold 2 times or 3 times. And those ETFs do not buy physical metal, they will buy futures or options. And they give the investors a leveraged exposure to the price changes, but they don't have the physical backing that these dozens of other physical ETFs have. I think there's a common, well, I don't think it's very common. There's a fringe of the precious metals market that believes that these ETFs that are physical ETFs that advertise themselves as ETFs that hold 100% of their metal. There's a fringe that believes that they don't actually have that metal, but the reality is that they do.
I see, but the leveraged ones, they're working fractionally.
Yes. Yeah.
I see. Okay. What percent of the overall market then would be these leveraged ETFs? Or is that an explanation for why some people believe that these markets are, being gamed and fixed by, by others?
I'll be honest with you, they are so unimportant to the markets that we don't pay attention to them. So I'm not quite sure how big they are, but my impression is that they are not all that big. It's primarily people, investors who, as I said, want leverage exposure to rising or falling prices that will do that. I don't think that those are the source of the volumes that give rise to the conspiracy theories and manipulation things. I think that the bigger volumes are in futures, exchange traded options, and over the counter forwards traded through the London market. I think that those are the volumes of paper transactions that some people just don't understand what they're looking at, and they get confused, and they say, how could anybody possibly be trading that much metal in the futures or forwards market and never take delivery?
Well, that's easy enough done. They're not buying the metal, they're just buying the price. So
right. And one of the points that we always make is, one of the things that the proponents of various theories will have is they'll say, well, if there wasn't a futures market and there's these billions of ounces of silver futures and gold futures that are trading in the futures market, if the futures market didn't exist, those investors would be buying physical metal, and the price would be much higher. But that's not an accurate representation, because 99% of the people who are trading on the futures markets don't want physical metal. They want leveraged exposure to price changes. And if you said, okay, we're taking away the futures market, you can no longer have that leveraged exposure to price changes. These are not people who say, well, I guess I have to buy physical metal. These are people who would say, I guess I'll go to a different market where I can have the kind of leveraged exposure to price changes, which is what I like to invest in.
So they would drive the people out of the futures market into something like that 2 and 3 times ETF.
Well, they'd probably be investing in stocks or currencies or bond markets instead of commodities.
Okay. So if an investor is wanting price exposure, where is it safer for them to be going? Into the things like GLD and SIL, or into the leveraged paper markets?
If you want shorter term price exposure, probably either of any of those go. Like I said, I really don't look at the liquidity and the open interest and trading volume in the leveraged contract. So I'm really not quite sure how liquid they are. I have investors and associates that I know who do trade those things. They've never had a liquidity problem getting those size. So I suspect that they are perfectly sufficiently liquid to allow investors to come and go with them. But obviously, you're playing with a greater leverage than you are with a regular ETF. So I think a regular ETF that has physical metal can give you the price exposure you want. The leverage guys obviously give you even more price exposure if that's what you're looking at. And then futures and options are out there too.
I see. So with the leveraged, is it a higher risk vehicle or no?
I'm not quite sure if the risk is greater. I guess you're putting up more because you're probably paying a little bit more because you're taking on that extra leverage and you're paying for that leverage. But again, like I just haven't ever paid that much attention to the multiple ETF multiples. And I should point out these things exist across assets. So you can go and you can see, leveraged 2 times, 3 times, long, short ETFs for any number of stocks, any number of stock categories, bonds, bond categories, currencies, and commodities. The idea of a leveraged ETF is not limited to gold and silver. This is an investment asset type or structure that has become common across financial assets of all sorts.
So when's the best time to be looking at those types of assets that in a market that's moving up or a market moving down?
Well, it depends. I mean, if you have a conviction because based on your own analysis or beliefs, if you have a conviction that the market is likely to move sharply higher or lower, then buying one of those leveraged ETFs can give you a multiple return in a very short period of time based on your thing. So, if you have a strong conviction for whatever reason that you think the markets could move boldly upward or downward, that's a good time to use those kinds of leverage ETFs.
Okay. Now, you were saying that because of their leverage, but they're not actually buying the physical metal, the leveraged ones, they're trading on the futures exchange. Is that correct?
As far as I know, yes.
So how does that work versus fractionally having physical metal in hand?
Well, I'm not sure what you mean by fractionally having physical metal in hand. If you have physical metal in hand, it's not fractional, right? It's there.
Yeah, but if, for example, when we were talking in Vancouver, I used the just simple numbers. I know they're not accurate, but a 10-to-1 where they only had to hold 1 ounce for every 10 was invested in. How does that work on a fractional basis for futures contracts?
Well, typically, like if you're buying a futures contract, your broker is going to require you to put up margin. And that margin is typically 10 or 15% of the dollar value of the contract. So if you're looking at a 100-ounce contract in gold, rather than buying 100 ounces of gold and paying the full price, you can buy a futures contract representing 100 ounces and put up 10 or 15% of the value. Then if the price of gold rises, you make that profit on the full 100 ounces, even though you've only deposited 10 or 15% of the value of the full 100 ounces.
I see. Okay. So in that particular case, if you're an investor in that type of thing and the price of the precious metal goes up, you're going to receive an outsized gain. Is that correct?
Yes.
Because it's leveraged.
Exactly.
I see. Okay. So if you're just looking for price exposure as opposed to it being an insurance hedge, then the paper markets are a better place for you to be looking to make your investment rather than the physical market.
If you're looking for a price exposure on a relatively shorter term basis, yes. Again, with futures contracts and options contracts expire, one of the attractions of ETFs relative to futures and options is that they don't well, the ETF options do expire, but the ETFs are shares, and as such, they don't expire. So you have a greater longevity of your exposure if you're buying an ETF, although you're not necessarily getting the leverage that you get on a futures market. But if you're looking for shorter term price exposure, the futures markets and the options on futures are probably the best approach for that kind of exposure. If you're looking for longer term exposure, then you probably want physical metal.
Okay, given the environment that we're in right now with the markets the way they've been for the last few weeks, then I'm hearing a suggestion that in a shorter term you'd probably want to look at paper versus physical. Is that a correct assumption, or are we looking at that we should be having a longer term outlook and be buying more physical? Again, no, not, everybody has to talk to their own financial planners, right?
Well, the second part first, because that's the easy part. You should always be looking to have exposure, physical exposure as a long-term investment. I mean, that just makes sense to have. And so I think that you should do that. On a shorter term basis, we're sort of at sea right now. I mean, it's interesting because we were just doing some work today. If you look at the first quarter returns of gold and silver, we look at 11 different asset classes, and silver was the best performer in the first quarter. 7% return, gold was a 6% return, and everything else was either 0.6% or -7%. These are stocks and bonds and cash and real estate and things like that. That was the first quarter. The second quarter is radically different for gold and silver, and the volatility across asset classes has picked up sharply. So right now, we're taking a very broken field approach to investing, and you see the prices come off, and it may well look like a good time to buy, and then they come back. I mean, if you just look at the last few days, I think earlier this week we told our clients to stand aside because the prices had risen, and we thought they were vulnerable to a downdraft. They came off a little bit. Then on Tuesday they rose sharply, and we looked pretty stupid. And today they've given up all of Tuesday's gains. So we're looking like maybe we were right to say it could be a good time to stand aside. But I think the volatility in precious metals and in other assets, stocks and bonds and currencies, is going to continue to be very high for the next several months, at least the next 4 or 5 months. And in that kind of environment, you have to be very adroit at getting in and out of markets if you're building short-term price exposure.
Wonderful. Now, your organization, the CPM Group, puts out annual yearbooks for all the precious metals, and I believe that the yearbooks for both gold and silver are out now currently and are available for the marketplace. How would somebody get a hold of a copy of these?
You go to www.cpmgroup.com, and we have a store there. You can buy the books. They're produced as PDFs, so they're ebooks. So you can buy the book online and then download the PDF. And if you want a printed copy, the last page of the report says, take this PDF to your copy shop, and these are the specifications if you want it print and perfect bound the way we used to do it. But the best way is to go to cpmgroup.com and just buy the book.
Wonderful. Thanks for joining me, Jeff. And I look forward to having more conversations about the precious metals markets.
I look forward to being here to have those conversations with you.
Thank you.